The broadcast is now starting. All attendees are in listen-only mode.
Good evening, ladies and gentlemen. Welcome to tonight's presentation. I did just start presenting, but it looked like I had it on mute. Can everyone hear me? Everyone there? Maybe if you write in the question section, yes, thumbs up. That would be a great start. How are we all doing? Excellent. We've got a few people that are on their keyboard, which is outstanding. Tonight's Self-Managed Super Fund Club webinar, monthly webinar, we're going to be covering off a few different things about the economic outlook. I'm going to come up with a few key ideas where I think it might be a good place to put some capital. But look, tonight's presentation is what's referred to as general advice. That means I haven't considered your individual personal circumstances when putting together this presentation. So look, while I'm coming out with prediction, they're my estimate, and I'm often wrong. I think when we look at Warren Buffett occasionally gets it wrong, then of course we're all going to make investment decisions that may not produce the outcome that we initially predicted. The goal of investing, though, is to try to minimize your losses when you do get it wrong and maximizing the gains when you get it right. I'll be talking about different ways that we can do that, and some of you are already implementing in your self-managed super fund portfolio throughout the course of the evening. We're going to be talking about the past. I'll be covering the markets in review, what's happened over the last 12 months, maybe even over the last 10 years, and give you a bit of an idea on where I think markets might be moving forward for the next 12 months and 3 to 5 years. But past performance is not an indicator of future performance. When we look at the Australian share market, let's hope the next 10 years are a lot better than the last, because the Australian share market hasn't done that much. But I'll talk to you a bit more about that in a moment. Okay, what else we got? My board game. I still have a few copies of my board game available. So many of you played the board game when we went around the country. I think it was 18 months ago now, actually. We have actually produced the board game. We're selling it for $79 plus postage. Now, the proceeds from the game is going to produce more games that we donate to schools. The goal is to have the game in every high school in all of Australia. For that to happen, we need to raise a little bit of cash to put them in the schools. However, before we need to put them in the schools, it probably needs to be in your household. One thing that I'm sure you wish, like I did, that some of the lessons of investing that we learned through the School of Hard Knocks was taught to us at school. And one of the biggest principles that we need to learn at a very early age is the benefit of compound interest. Everyone I speak to wish that they understood compound interest a little bit earlier than probably when they do, because it's not something that you get a second chance on. The essence of creating wealth is that it does actually take time. This takes a staircase. There's no elevator, unfortunately, to wealth. However, as we saw late 2018, there is an elevator down sometimes on markets, whether we look at the performance last year on global share markets here in Australia. Even the property market, if there was a barometer where we'd be able to measure property on a day-to-day basis like we do the share market, I'd like to. I would have thought it's probably performed similar to the Australian share market, because after all, the Australian share market is meant to be a barometer of the overall Australian economy. So grab a board game, email admin at the SMSF Club, and we'll get you a copy. Great birthday present for your kids. Great addition to your family for the grandkids. Yeah. So let's look at the markets. Why did global markets fall in late 2018? That's an interesting question. If we look at 2018, there was many share markets around the globe that fell almost 20%. Excuse me, and the Australian share market wasn't much different. It did fall like the rest of the market. So let's have a look at why global markets fell first and foremost. Well, one of the biggest uncertainties in the market was centered around global growth, specifically that in the United States. Why the United States is such a powerhouse is that it's the largest economy in the world. There's a huge amount of the population that consumes a lot of stuff, right? That makes it one of the largest, if not the largest, trading partner for the majority of countries in the globe. And it's no different to that of Australia. They're one of our top 3 trading partners year in, year out, and has been so for a long time. So when the US market sort of took a bit of a breather, many people thought that the growth that's experienced over the last 10 years is coming to an end. A lot of people took profits and thought, well, hang on a minute. If this global growth that we've forecast isn't sustainable for the foreseeable future, then what's going to happen to asset prices? And because of that uncertainty, we saw a lot of people flee the equity markets, and that was measured by the number of sellers that were in the market on a day-to-day basis, causing the market to fall. China trade tension led by tariffs and uncertainty around tariffs between Trump and that of China didn't help global markets. Earnings volatility, companies were coming out with earnings uncertainty and a few downgrades. A lot of that stemmed not just for the broader US market, but some of the largest companies in the world. When we saw the Apple, largest company in the world, had a downgrade, which caused the share price to fall almost 40% in the last quarter. So, what is one of the companies that I would imagine the majority of us have bought a product from? I have an iPhone right in front of me. I no doubt you probably had an iPhone or got an iPhone in front of you. When many people think that companies that are more manufacturers and producers rather than tech companies like Apple, their earnings and the share price is just as volatile as what it has been in the past. There's a lot of pressure in the United States of the risk of rising inflation. With rising inflation, that leads to rising interest rates. All these uncertainties were late 2018. In the United States, we had political dramas with all the issues with Trump. That seems to be a daily circus act. So let's look at the Australian share market. Well, what's affected the Australian share market rather than looking at those global macro principles? What's caused our share market to fall here? Well, same thing. We've had global growth uncertainty, China trade tension, risk of rising inflation in the United States, which affects us. Rising interest rates. Many people late last year thought interest rates were going to rise further and further in the US, including the Fed Reserve themselves. Here in Australia, many people anticipated late last year that the next move for the Australian RBA would be to increase interest rates. Political dramas globally, but here locally on the Australian share market, what's probably had the biggest influence over the last 12 months is the Royal Commission into the banking sector and the financial services industry. To put it into context, the Royal Commission created a fair amount of uncertainty. No doubt you read in the paper daily, like I did, that that these bankers should be ashamed of themselves. And not just the top 4 banks, but you go down to the financial services providers, financial planners, you go to the insurance people writing insurance, the people in superannuation. Look, every day it seemed to be a horrific story that questioned the integrity and ethics of our entire banking system. So that uncertainty around the Royal Commission has caused the market to fall. Every day we're reading negative news, and every day the market was trying to analyse, well, what is the impact of the Royal Commission? What is the outcomes likely to be? And many people thought that there was going to be systemic issues and huge issues that's going to be last for a long time, especially for the top four banks. Now, the financial sector here in Australia and the banking system makes up around 30% of our overall economy. So when there's a shadow that comes over, and it was a dark shadow, it was a very dark storm, the Royal Commission comes over 30% of the economy. Now that 30% of the economy somewhat stimulates the rest of the economy. Remember, businesses, us as individuals, when we're looking at investing or buying our own home, most of us borrow money. So when there's a big cloud that questions the ethics and integrity over the banking sector, it's going to have a big impact, not just on the banking and finance sector itself, but all sectors, irrespective of what industry you're in. And that's what we've seen. Every day as the biggest bankers in the country have been put under the spotlight and questioned about their ethics and integrity of their company and their employees in many instances. What has occurred is that those banks have gone to be extremely conservative as their number one priority has shifted from making shareholders a profit to that of maintaining the reputation of the company that they work for. Now, because of that, no doubt you've experienced the problem, or certainly heard of the problem for people that you know, no doubt. The banks have essentially stopped lending people money. You go back a few years ago, like money was freely available. Banks were in the business of writing loans because that's what they do. They write loans. But over the last 12 to 18 months, since the Royal Banking Commission has had the spotlight on the integrity and ethics of the industry, they've gone to protecting their reputation at all costs. What that's meant is that they haven't lent anyone money. Now, that's okay for banks' profits because they'll stay the same. There's no ability for you to refinance because if you're looking for an extension of an interest-only loan that fell due over the last 6 months, then the bank you're probably with going, we're not extending it. You've got to go to P&I. And generally in the past, you go, well, that's fine. I'll just go refinance with another bank. And here, over the last 6 months, they've gone, yeah, that's fine. Happy to have you off our books. Then you go next door to the competing bank, I want an interest-only loan, and they turn around to you and go, well, we're not lending today. What that's meant is that everyone stayed where they are. So banking profits have been quite stable and earnings have been quite stable over the period because we haven't had people shifting from one bank to the other that has historically been the case. However, for the overall economy, if people aren't borrowing, then and people want to sell, there's no buyers in the market for property. Same thing with businesses. If they're using debt to help fund growth, as many companies, if not the majority of companies, certainly listed companies in Australia do, if they're not able to borrow money, then their growth is going to be tarnished as a result too. So this Royal Banking Commission has caused a lot of grief for the overall economy. Like, it cost taxpayers $75 million for the actual legal bill to conduct the Royal Commission, which is a huge amount of money. However, the flow-on effects for the cost of the overall economy would be in the tens, if not hundreds of billions of dollars. One of the biggest things that I think a lot of people on a daily basis misunderstood is that while the number one goal of the Royal Commission was to sort out the ethics and integrity of the finance industry, but according to the Treasurer, the day that the handings were come out, the Treasurer came out and said, look, in a close second, it's to ensure the free flow of capital to banks and individuals for investment and growth. And it's because of that last point, I think that there's going to be very little action by way of follow-up on the Royal Commission. We've already had Bob Catter come out and say another cent or second spent on the Royal Commission is a waste of people's time and money. And I agree with him. The biggest beneficiary out of the Royal Commission, I believe, is going to be the top four banks. So while the top four banks and their unethical behaviour was what brought about the Royal Commission in the first place, the outcome is that they're going to have a lot more favourable business conditions moving forward with a lot less competition. One of the findings that most people have been speaking about and recommendations was to remove mortgage broking commission. Now, whether you like that or not, what it is going to create is going to be less people in the marketplace providing loans, which means the top four banks are going to pick up a lot more market share, which highlights one area where I think the banks are going to be the biggest beneficiary of the Royal Commission, where unfortunately they probably should have been the biggest casualty. I'll get to more to the banking sector in a moment. So that's the Royal Commission and how it's had an effect. Now, I think moving forward, now the Royal Commission is over, if we look at the banking and finance sector, they're going, well, that wasn't too bad. Our reputation, we've been in the spotlight for long enough. It's moved office onto another thing. What we're going to do now is concentrate on what their job is, which is to create shareholder value, to increase the wealth of their stakeholders, whether that's shareholders, clients, or staff. So I anticipate in the next 6 months, the free flowing of capital is going to be released a little bit, and probably a lot more in 12 months' time as we get to more and more favourable banking conditions and lending conditions for the overall market, which is good news, not just for people in banking stocks, but also the broader economy, whether it's you as a business, whether it's you as an investor, whether it's you as a property investor. Political uncertainty. The other thing that's caused the share market late last year, and what we've seen, just to finish on the Royal Commission, is that since the Royal Commission is over, we've actually seen the Australian share market go up by about 10%. When the day the Royal Commission was handed out, the banking sector, AMPs of the world, they were all up between 5 and 10%, some of them 15%. So that shows that the market has anticipated that, hey, the biggest beneficiaries of the Royal Commission, so it's not just my view, is going to be the banks. Political uncertainty. Here in Australia, we've had more politicians than most years over the last few years, which is unfortunate because prior to all this uncertainty over the last decade, the decade prior to that, we had one of the most stable political governments in the world. Unfortunately, that has shifted over the last year, and once again, irrespective of whether it's Labor or Liberal, we seem to have uncertainty as to which direction the country is going to be led. And that's going to continue for the next few months until such time there's a bit more certainty around who's going to win this election. Either way, you look at the Liberal Party, they're proposing some pretty drastic changes to franking credits, which affect us as self-managed super fund investors, especially if you're in the pension phase. We're not getting a rebate for those franking credits. That's a big decision. And if I was you, I'd be really considering the Liberal Party and their policies around that, because it's going to impact your bottom line, not just when you retire, but your superannuation balance prior to it. Because where we are right now is that if you don't get those franking credits back, you're basically paying an additional 15% tax on any income earned within your fund if you're in the accumulation phase. If you're in the pension phase and you're earning dividend income, then you don't get that rebate of those franking credits that have already been paid. It effectively means you're paying 30% tax on your super money, which is unfortunate. Once again, the people with the least amount of money are going to be the most affected. Those people that have saved, they've invested, then they've become self-funded in retirement. These changes mean that those people are going to have less money in retirement, which is unfortunate. That's the Labor policy. Labor policy also has got policy around negative gearing. It's got policy to change around capital gains tax. And the discount that's applied for when you hold an investment for longer than a 12-month period. So we look where we are right now with political uncertainty because of those proposed policy statements that have come out from the Labor Party. That's creating a lot of uncertainty across the property market and the Australian economy, as people are going to sit on the sidelines and just wait. And it's that uncertainty, that waiting period, rather than stimulating activity and stimulating buying, that causes a lot of asset prices to go down in value. And I think that's a systemic issue as to why we've seen property prices go down when it's combined with the fact that the lending environment has pretty much all but ceased, certainly for investment property. So the supply has stayed constant, yet buyers aren't as eager to invest because they're sitting on the sidelines because of the political uncertainty, and also the flow-on effects from the Royal Commission, which is related to their ability to borrow to fund acquisitions. So look, that's why the market has gone up and down over the last, late 2018, I believe. There's been a lot of global growth uncertainty, US earnings volatility, rising interest rates, or the prospect of rising interest rates, China trade tension, Royal Commission, political dramas, both offshore and onshore. But where we sit today, what we're almost March, we'll be in a few days. I think global growth uncertainty, there's a lot less uncertainty today than what there was previously. Inflation in the United States seems to be more stable. In fact, the Federal Reserve have come out and said that they're looking at policy easing as opposed to increasing rates, which has taken a lot of pressure off rising interest rates. If you look at the Royal Commission, it's over, and look, everyone was fearful. And again, the Royal Commission's been a waste of money. The 7 Royal Commissions had the same advice previously, that there's a conflict when people get paid. Well, when I go to the doctor, there's a conflict, right? I go to a doctor, I pay him, there's a conflict, right? If he refers to me to someone, there's generally a conflict. If he sells me medication, there's generally a conflict. There's conflicts that exist in everything. Like if I borrow money off a bank, yes, there's a conflict, but I know that because I've got to pay them an interest. And I know that they're probably going to make a profit on that interest. So for the Royal Commission to come out and say, you know what, there's conflicts that exist, and if we remove these conflicts, the world will be a better place, that'd be great. But I think in the real world, we just got to come to terms that conflict exists. Provide they're disclosed and we understand that, then maybe that is probably a better action item moving forward, rather than continually spending taxpayers' money or wasting taxpayers' money on further inquiries to come out with the same outcome. Political uncertainty, well, look, that's going to be the case until such time this election is called, and the election is won by a particular party. But as an investor, look, I don't want the negative gearing to be changed. I don't want taxpayers to be, or individual investors not to be able to claim negative gearing. I don't want my mum's income in retirement affected because she can't get franking credits back. I don't want my accumulation fund to be affected because I don't get rebates for the franking credits between the difference between 30 and 15%, which is meant to be the tax rate for income in my super fund. So I don't want any of that to happen. And look, you should look at where your interests lie. Not that I want to influence your political decisions, but I think as investors in overall economy, the current policies coming from the Labor Party, it creates a lot of questions and doubt over the future. So property, look, we've got property. Where are we right now? Let the bloodbath begin. This has been the headline only a few weeks ago. House prices in Sydney and Melbourne could halve. Worst crash since 1890. 1890 is going back a long time. Western Sydney and Melbourne property tumble into negative equity. Financial Times view of Australian property downturn. So there's a lot of negative news in the marketplace. But look, personally, I think now's the time to invest. Warren Buffett talks about the time to buy is when there's blood on the streets. It is a bit tough to buy now with lending restrictions and all that sort of thing. But look, if you look at buying property for 10 years, 5, 10, 20 years, pretty confident that if you're buying a good location, a great property, then it's probably going to produce a pretty good outcome. That's my view. Look, what property you own and whereabouts. Look, that I'm not a property expert. I'm probably less experienced as a property investor than you. But I do look at the macroeconomic climate. I expect that people are going to be able to borrow a little bit easier over the next 12 months than the last 12 months. Right, so that's going to create a little bit more buying stimulus. There's speculation in Australia that the next interest rate is going to be down. If that passes, if the banks actually pass on that interest rate cut later in the year, then that's expected to stimulate more buying and more affordability in the property market. So I'm basing my decisions on economic factors, not a specific property area. That's not my interest, and you need to do your own homework about that. But from a property investor's perspective, I probably wouldn't be looking at selling an investment property now if you could avoid it. Look at the share market. Look, that is the United States share market there since what we're going back. If I look closer to that data, January 2005. So we had the first upswing, or the last upswing of the GFC, which lasted a few years. Then we had the global financial crisis, where the Dow Jones index fell from 14,000 points down to 7,000. It halved, what I'm talking about there. I'll see if we can bring up a pen. Is this period here. That's a GFC. Since the GFC, so since where we are here, right, this point, where the US share market, the Dow Jones, which is a measure of some of the largest companies listed in the United States, since January 2009, we've seen a massive increase in the United States share market. Massive. It's gone from 7,000 points to 25,000. Right? It's gone up not just 100%, but a multiple of that. The performance of the US share market over the last 10 years has been absolutely phenomenal. And many of you have ridden on the coattails of Warren Buffett and enjoyed in that upside along the way. Berkshire Hathaway is the true American company, has benefited from that swing as well. Let's have a look at the Australian share market measured by the ASX 200. See if this works. Oh, no, I don't want that. Trying to get back to getting off the... Oh, that's not going to work. Bear with me one tick. Working out my tools. There we go. There's the ASX 200 index. Now, it looks somewhat similar to the Dow Jones because the actual y-axis is different to factor it in. But what I want to do is just to compare the United States share market to the Australian share market, is overlay those two charts to give us a bit of more clarity on how they've performed in comparison to each other over the last decade. So there we are. We're going back to April 2009 as a starting point. The blue one is the Dow Jones index, which is up, 230% from that period, where the Australian share market is only up 70%. Now that's from 2009, right? 2009, we're up 70% over the last 10 years, which annualized isn't that high of a return. I think it works out to be around 6.5%, where the Dow Jones is more like 12%. It's more than doubled. It's up 220%. So if you invested 10 grand, your investment would be worth around 300 or 32 grand today. If you invested 10 grand in the Australian share market, that'd be worth 17 grand today. If we go back to these charts, what's also interesting here is if we draw a line, maybe, I'll go back to the pen, is the US share market from this period. It's gone up a lot. If we look at this period, which is the high of the GFC, our market is down. So while the Australian share market is up, if we look at 10-year period, if we go back another year, the Australian share market is actually down from its previous highs, where the US share market is still significantly above those previous levels. Let's see if I can get off this now. Oh, no. Race. I don't want that. There's the overlay. So if we're looking at following the Warren Buffett philosophy, of buying when there's blood in the street, the Australian share market looks cheap and attractive when compared to other share markets around the globe, especially if we look at the Dow Jones, which is the measure of the US share market. So where we're at today, the Australian share market looks cheap when we look at the overall market. But rather than looking at the overall market, I think we need to hone in on not just the market, but individual sectors. And within those sectors, maybe look at individual stocks as opposed to taking a broader view of the overall market. Now, when we go to more of a sectorial view rather than a market view or an individual stock perspective, we just got to be conscious that if we put a large investment into those sectors or those stocks, we're taking on additional risk. I'll get to that in a moment. So where to from here? Look at market fluctuations as your friend rather than your enemy. Profit from folly rather than participate in it. Now, if we look further, and I'll touch on Buffett, I'll look at 10 things that I've learned from the Berkshire Hathaway annual letter to shareholders that was released on the weekend. I want to go through before we do that and look at one of the principles that Warren Buffett applies when investing. Now, his sole job, really, his main job, what he's been so successful for so many years, is that basically the allocation or deployment of capital. He invests, right? That's essentially what he does. That's his core competence. So in the AGM, the annual letter to shareholders on page 4, he reminds us of his prime goal in the deployment of capital, his prime goal when it comes to investing. To buy outstandingly managed businesses in whole or part that possess favorable and durable economic characteristics. We also need to make these purchases at sensible prices. Right. So what Warren Buffett looks for in investing is stable businesses that have got a proven track record in producing very consistent and stable earnings and net profit. That's essentially why you buy a stock. You buy a stock, there's two types of investors: to hold for the long term as an accumulator. So you buy a stock to be a company owner. You want to own in the future dividend income, like through profits through dividends, and also the growth of that company over the long term as a shareholder, as the share price in the company expands. The other type of investor is a speculator who buys and sells shares to trade, right? I'm not worried about traders. I'm not looking at traders as a way to make money. Let's look at how Warren Buffett has done it through the safe and the proven way, which is buying quality companies and holding for the long term. One of his measures of a quality company is consistent long-term profit, right? Now, I'm going to bring up a chart here. Now, that chart, I'm not going to tell you the stock. I'm not going to tell you the name of the company. We might have a bit of a guess. Here's from 2009, so I'm going back 10 years. Now, 2009, 2010, 2010, the company made net profit at $4.5 billion. 2011, it made a net profit, which is the blue line, of $5.4 billion. Next year, 2012, earnings fell a little bit, went down to, net profit to $4 billion. Next year, it was back at 5.4. 5.3 billion was 2014. 2015, 6.3 billion. 2016, 6.27 billion. Now, this is net profit, right? Net profit of the company. 2017, 6.6 billion. 2018, 6.56 billion. Now, if we flow down, you look at the dividend income. So earnings there is quite stable, right? We've got 2009 and where we are today, it's a lot higher, right? 2010, where it's $4.5 billion, it's now $6.5 billion. So it's actually substantially higher. Now, if we're looking at the key measure of owning a company is to enjoy future growth, and as net profit increases, to get a higher dividend. That's our criteria of making a quality investment as an investor, right? Dividend income, 208, 217, 248, 257, 271, 286. This is the total dividend paid for the year for this stock, and then 282, right, for the last few years. When we look at stability and long-term track record, now I'm just looking at 10 years, but if you go back for 50 years, it's a similar track record for this particular company. However, let's look at the share price. This is the earnings quite stable, right? It's gone from the left side to the right stable. It's all very similar. The dividend income has gone up slightly, again showing a very stable dividend income across the period. Actually, before I show the share price, does anyone want to have a guess at what company it is? Put in your box as to what company this is in the question section. See if you can say it. Yeah, someone's had a guess. Close. Yeah, so a few people putting their guesses in there. Excellent. If you look at this, though, maybe you put in the question areas, do you think it meets the Warren Buffett investment criteria? Stable earnings, long-term track record, net profit of pretty sizable, right? We're talking 5 to 6 billion, and a very consistent dividend income. Does it meet our investment philosophy of stable income, happy to own that in the future? Well, let's have a look at the actual price. While earnings have been stable and the dividend income has been stable, the actual share price has been quite volatile. In fact, where it was back in 2009 to where it was in 2015, the share price actually increased 143%. From those highs in 2015 to where we are today, though, it's fallen 45%. So if we go back and we look at the earnings, the earnings is quite stable, right? The dividend income is more stable even, which is why we own shares, to get that dividend income and to enjoy in the future growth. So this depicts a very stable company, right? However, when it comes to the irrational behavior of investors, the actual share price depicts a completely different story. It's up 145% and down 45% as irrational behavior responds to the uncertainty that the media or the noise in the market portrays. Right, the recent fall from 2017 from $33 down to $22 was a result of the Royal Commission. Nothing that's affecting earnings, right? They've made some write-offs. However, the share price has come down substantially. This is where it represents an opportunity, I believe. The company that I'm talking about, no one I think got it right, a few people were pretty close, was National Australia Bank. Banking earnings are quite stable. I'm not too sure about you, but my prediction of the banking earnings in the future is going to be more than where we are today. Because what I've realized, and my grandfather gave me advice when I was very younger, is that banks always make a profit. Don't worry about what interest rate you're borrowing at. It might be cheap, but you don't need to ask how they're making money. You just got to understand that they're going to make a lot of cash from you as an investor, especially if you've borrowed money and hold it for a 25-year lifespan. Right, they're going to be paying a lot of interest over that period, and that's just for you as a loan, let alone the hundreds of thousands of loans each bank write every year. So what I want to portray there is earnings have been quite stable for the bank to rising. Dividend income has been rising to stable more recently. I'm pretty comfortable with the forecast that dividends and earnings are still going to be stable in the future. So over the last 10 years, we've had the GFC, the recovery of the GFC. We've had the uncertainty around the Royal Commission more recently. We've had global growth tension. We've had political dramas here in Australia where there's been, 5 prime ministers in that time, right? We've had all of that uncertainty, and every time there's been something to worry about. Every time looking at the share market, there's been plenty of people who have been selling on the back of that news. However, earnings has been constantly increasing. Dividend income has been constantly increasing, which is the reasons why I own a company, to enjoy the earnings growth, to enjoy the dividend income. Eventually, the share price will follow. So if we're looking at market fluctuations, you're a friend rather than your enemy, you profit from folly rather than participate in it. If one of the biggest uncertainties on the banking sector has now been overcome, then maybe it's time to get back into banking shares. And for me, my investment's been in National Australia Bank. I tried to be tricky and try to time the market personally, and I bought in a little bit earlier than waiting for the Royal Banking Commission to finish. But even though the Commission and the findings come out, we saw National Australia Bank shares go up with the rest of the banking sector, but sort of done nothing for the last few weeks, come back slightly. So it's still a great opportunity to be buying NAB. We're not buying it at $22, but at $24.50, I think it's a great buy. At $24.50, if it gets back to $32, which is just like halfway back to its all-time highs in 2015, you're still going to make a very attractive profit. I'll get into that in a minute. So my picks, so we've looked at the past and what's caused the market, and those uncertainties are going to exist every day. I've talked about the things that have plagued the market over the next 12 months. In the next 12 months, there's going to be just as many things that have plagued the market, maybe potentially different things, hopefully. Sometimes the market can remain irrational for longer than you can remain solvent. That's a Warren Buffett quote. An economist will tell you today why what he predicted yesterday didn't happen. That was on the wall of my economics teacher back in 1994 in year 11 economics. Might have been year 11, 10 economics. So to give you confidence, like Warren Buffett has made some silly investments of his time. These are my picks as to what I think are the best investments for 2018 and beyond. First one is National Australia Bank, but to buy them with put options just in case I'm wrong. And as an accumulator, it's a very easy decision to buy that dividend because it doesn't cost much in the overall spectrum of our portfolio. Yet it mitigates all the downside risk, not just of the overall market, but the stock-specific risk if something happens to NAB. Now, NAB is an interesting pick out of the banking sector because they were singled out in the Royal Commission. To be singled out in the Royal Commission caused their CEO and their chairman a lot of grief, as both of them had to fall on their swords a few days after. However, why I'm recommending NAB as opposed to the other banking stocks is I think it's fallen the most as a result of being singled out in the Royal Commission. Sure, we've taken a little bit more risk with that, is if there is systemic issues in NAB that isn't in other banking stocks, maybe the three other banking stocks, ANZ, CBA and Westpac will go up, while NAB to change their ways to come into line with the ethical and moral standards that society expects these days, it may cost them more. However, the share price has fallen further than the other three. That's why I'm recommending it. I don't think the reputation is going to suffer that much by being singled out when it's such a systemic issue across the entire banking sector. Number 2 is follow Buffett. And what we mean is follow Buffett. We don't need to reinvent the wheel. Let's just look at investing where Buffett does. Now, Buffett's come out and single-handedly said that the company that meets his investment criteria the best is Berkshire Hathaway. And I'm happy to keep buying Berkshire Hathaway stock. If Warren Buffett thinks it's cheap and trading below intrinsic value, then I'm even more eager to buy it. The third part that I think you need to consider is risk management. Like, I'm not saying to go out there and buy all your money in National Australia Bank and Berkshire Hathaway shares. That would be madness. What we have to consider is risk management. So I'm cautiously optimistic that the outlook for Australian shares, especially the banking sector, which is a big call right now, especially NAB, when it's probably out of favour for most investors, is a good time to be investing. But we can buy it with a bit of confidence if we buy protection to mitigate the downside. So that's a risk management, how we can adopt or to mitigate the usual risks of investing. The second part of risk management is diversify. Don't put all your eggs in one basket. The third part of risk management is to ensure you have cash available for opportunities. If we go back to the Warren Buffett annual letter to shareholders, on page 6, Warren Buffett came out and said, Berkshire will forever remain a financial fortress. In managing, I will make expensive mistakes of commission and will also miss many opportunities, some of which should have been obvious to me. At times, our stock will tumble as investors flee from equities, but I will never risk getting caught short of cash. He's talking about his current cash pile. He's sitting on $112 billion at the end of the year, US dollars in cash and US Treasury bills. He's got other fixed income instruments that equals $20 billion. So that's US, 132 US billion at year end, which probably works out that he's probably got 200 billion Australian dollars sitting in cash, which is twice the size of CBA as a company. It's bigger than BHP in its entire BHP's market capitalization. Warren Buffett's sitting in cash. So cash is great, and I suggest you to look at your self-managed super fund to review if you're trying to make your super fund a financial fortress, then what sort of cash do you need to sit on waiting for investment opportunities? Or what other ways can you implement risk management? Maybe that is buying NAB with a put option. So there's National Australia Bank, there's its earnings, there's the share price. Now, if we get back to where we were only, 12 months ago, to $32, that's a 30% increase. So let's look at the strategy of the JB way. Today, I bought some stock. I bought 1,000 NAB shares, $24.50. That cost is $24,500. Purchased 10 December 2019, $24 put option. So that gives me the right to sell my shares at 24. Now, I bought it at 25. So if the share price falls, I'm selling at 24. So that's a 50-cent loss. But if it fell down to $12, rather than losing $12.50, I'm only losing 50 cents because it's guaranteed that I can sell it at 24. The cost of that put option was $1.95, so it cost me $1,950. My maximum risk is therefore $2.45, which works out to be 10% of my purchase price. That is the maximum risk, assuming National Australia Bank went broke or for some reason didn't make the stable net profit before tax like it has previously. It doesn't pay out that stable dividend that is pretty constant. So if it went completely broke, doesn't pay that dividend, my downside maximum amount I can lose is 10%. Now, if National Australia Bank goes broke, it's not just the National Australia Bank that's going to suffer, but I reckon the overall Australian share market is going to plummet considerably, which means the theory of diversification probably hasn't worked either. The expected dividend, if it maintains a dividend as it has over the last 5 years, the total dividend is $2.82. So that means I'm going to receive income over the course of the year of $2,820, which well and truly covers the cost of the put option. The cash flow after the dividend is $870, which is 1.5%. Beats having money in the bank account, right? The risk is if the company doesn't pay that dividend, right? Our downside risk is $2.45. The upside, though, is if the share price goes to $32, I make 30%. I make 30% by risking very little. So there's a cash flow forecast, or the payoff diagram. The red line is buy and put options. If we include the dividend income, then even if the share price does fall to 18 or back to zero, provided it pays that dividend, I'm not risking a cent, which makes National Australia Bank a pretty good attractive investment. We're buying when it's cheap, when there's blood on the streets, when things couldn't appear to be any worse. The bad news is over and done with, well, by the looks of it, with the Royal Commission coming out only a few weeks ago. So I think the timing is right to be investing in NAB, but only with put options. So let's look at some questions. This is good. With proven consistent dividends and profits in NAB, should those shares have been kept and not sold before the commission? That's a great question. I think a lot of people, like last year, I recommended people to sell their NAB shares. Now, we had the right to sell them by exercising our put option at like $29.50 for the majority of us. At the time, the share price was trading at 26. So if I can sell a stock at $29.50 when they're trading at 26, I'm going to exercise that right. At the time, I didn't want to reinvest straight back into National Australia Bank because the Royal Commission was still going on. So we sold at $29.50 by exercising our put options. We've sat on the sidelines. The uncertainty is now over. Now I'm recommending for us to buy back in at the $24.50 mark overall. Now that doesn't take into consideration your personal circumstances, so you need to consider whether or not it's right from you. But as an investment, I think it's a great allocation of your capital for some of you, not all of you. Why NAB over CBA? Good question. As I said, look, I think I may have addressed that, Chris. The reason that we're looking at NAB is that, look, I know the company because I've owned it for a long period of time. I'm familiar with it, more so than CBA. Although my personal bank account is with CBA from the Dolomites account back when I was 4 years of age, or 5 years of age, went to school. Went there with my 50 cents and handed to the lady to put into my bank account. No doubt many of you guys had a Dolomites account as well. Look, either way, if you've got a problem with NAB, then choose one that you're comfortable with. I think overall the top four banks are going to do similar, right? Why I'm choosing NAB is that I think the downside has been more on NAB with this extra concern. Now they've lost their CEO and their chairman. So I think we're buying at a lower price relative when we're looking at the other banking stocks. But look, that's just my personal view. If you've got a personal preference for another bank, then by all means, the payoff is similar. Like the cost of the put option is similar to National Australia Bank in percentage terms, and the dividend income is very similar to NAB for the other three banks. Okay, there's a few more questions, but I'll get to them. Great question, Deb. The put option, if the put option costs $1.95, why is the downside risk $2.45? Let's have a look at that. I'll just go back to the part. So if we look at this point here, I'll highlight it. While the cost is $1.95, which you correctly point out there, what we also have is we're purchasing the share at $24.50, but we're only protecting it at $24. Right, so if the share price fell or stayed the same at $24 over the period, we'd be out of pocket the $1.95, which is the cost of the put option. We would then be selling it at $24. Say it's at $12, we'd be selling it at $24. We bought it $24.50, so we'd be making a capital loss of 50 cents, which gives us a total downside risk of $2.45. Hopefully that answers your question. Perfect. Okay. The yellow wouldn't have been my choice of color, but hopefully you can all see that. Okay, next part. Now let's go to the National Australia. The Berkshire Hathaway Warren Buffett annual letter to shareholders. So Warren Buffett's annual letter to shareholders, it covers off basically everything that Warren's doing for the year, his view on the overall markets, investment philosophy, the economy, and life. And look, a lot of people like me eagerly wait that and sort of get excited and lose sleep for months in the lead up to it being released. Unfortunately, this year, it was a bit dull. His usual wit and humour wasn't in there for the majority of it, and it was only 14 pages long, which made it one of the shortest reports in history, if not the shortest. So there's a few things that came from it. Now, the first page of this, I emailed you the actual report, the letter on the weekend, or the link to it. And also some of the key findings. But I'm really just going to look at a few key points rather than regurgitating the stuff that I put in the email. The main point is the compound annual gains, 1965 to 2018, so a pretty long period, right? There's been plenty of ups and downs. There's been plenty of recessions, depressions. There's been plenty of changes in government during that period and plenty of things to worry about. Despite all of those things to worry about and the ups and downs, the compound annual gain in the Berkshire Hathaway share price is 20.5%, which makes Berkshire Hathaway the best investment vehicle of all time. The investment philosophy that Warren Buffett adopts, though, is the old-fashioned buy, hold, don't stuff it up sort of philosophy. He looks for elephant-sized acquisitions because he's got such a large cash. He buys quality companies, but only when they're trading at a price below what he deems as intrinsic value. That intrinsic value is determined by a discount to the intrinsic value that he calculates, which creates a margin of safety. So he likes to keep it simple. He buys simple businesses that he understands and has a fair confidence in their track record and future outlook. He looks for companies that have what he describes as a moat. Like it's a moat to competition. It's very hard for people to come in and pick up market share. Berkshire Hathaway is the largest shareholder of Coca-Cola as an example, and he's held it for a long period of time, right? He says that if he gave someone $100 million to spend on marketing to take away the market share in the soft drink industry as Coca-Cola has, he would give him back the 100 grand and say $100 million and say, look, it's humanly impossible. You can't take that market share off a company that has such a historical presence in the marketplace. So he looks for simple companies that have got a moat, that have got a consistent track record of making quality earnings, so he can calculate in the future that those earnings are going to be maintainable. It's not complex. He doesn't have a punt. He doesn't roll the dice. As I said before in his comments, is that he's probably going to miss out on a lot of opportunities. He will. He's missed out on a lot of opportunities in the past. What he described that some of them should have been very obvious to him and Charlie, his business partner. But in the end, he doesn't want to take on risk. He wants to buy quality companies with quality management that meet his strict formula. And that formula hasn't changed in the last 50 years. There's his office. That's not the entire building. He's got half a floor there on level 1 of his office. There's a photo of my team a few years ago when we went to Omaha, Nebraska for his annual shareholders conference. That was in 2015. Second thing to come out of the shareholders letter is cash is king. Build a financial fortress. You want to have cash for when opportunities present themselves. Don't just spend money for spending's sake. Do quality research and invest it astutely. I find a lot of people in the self-managed super fund segment spend their money in their self-managed fund or invest it without taking too much consideration to the investment at all. In fact, I know a lot of people that would spend more time trying to save $100 on a fridge at the local Good Guy store than what they're going to do with their retirement savings. So we need to build a financial fortress. We need to build education around what we're investing in, and we've got to have a cash buffer to ensure that your cash flow is met and also to ensure that you've got a bit of ammunition when buying opportunities present itself. There's Warren Buffett's house. That's our team again in front of Warren's house. It's the same house he bought back in 1965. He's been living in for a long period of time. That's a keep it simple investment philosophy. Even Warren and Charlie are often wrong. At the AGM, I've been there 3 times now over the last 10 years, and he talks about how he gets it wrong, and he cops a lot of criticism from investors as to how he gets it wrong. Recently, just in the last week, we've seen Kraft Heinz, which Buffett made a big investment in back in 2013, suffer a lot. And he's been criticised even here in Australia in the media about his investment in Kraft Heinz and how he got it wrong. Despite that, if we look through to the annual letter to shareholders, it outlines some of the biggest companies that Warren Buffett through Berkshire Hathaway owns, and he highlights his investment in Kraft Heinz. At year end, their Kraft Heinz holding had a market value of $14 billion, a cost base of $9.8 billion. So despite copying a lot of criticism for getting it wrong recently for Kraft Heinz, he's still up, $4.2 billion from what he purchased it at. That's at the market value at the year end, not where it is today. It's just reporting on what's written in his annual letter to shareholders. So look, when you are wrong, make sure that you've got a margin of safety in the hope that you're not just going to mitigate losses, but you might make a bit of coin as well. The other part of where he is wrong is they're criticising the performance more recently. Obviously, he bought at a very sensible price a few years ago, which has provided that margin of safety. He bought when there was more blood on the streets than where we are today. Number 5, Warren believes over the long term, share markets offer the best long-term returns. But he has no idea what will happen next week or next year. So when we look at the earnings potential of National Australia Bank, I can say with a fair amount of certainty that the net profit after tax is going to be somewhere around where it was last year. It may go down a little bit for write-offs and provisions for claims through the Royal Commission, but I think their underlying earnings is going to be quite stable. And as a result, I think the dividend income and dividend payout is going to be quite stable. However, I've got no idea what the share market and the share price of National Australia Bank is going to do. As you saw on the chart before, it's a lot more irrational. It goes up and down every day on noise rather than looking at the fundamentals of the overall company. But eventually, over time, the share market isn't a voting machine. It is a measure of value. So eventually, the share price will be a correct value of measure of value and a correct measure of those earnings per share and that dividend income. It may take time for the market to become rational, and it may become irrational on the upside where the share price goes well above what is fair value, which is often the case. The market is a pendulum. It goes from extremely undervalued to extremely overvalued. The idea is to buy when blood on the street, when things are cheap, but to do that, you've got to buy when the things look the most uncertain. So if anyone tells you what the share market will do tomorrow or next week or next 6 months, they're really guessing. Of course, it is a voting machine, and what's going to influence that is the psychology of the market or people. But over the long term, the market should become more and more rational. It's a photo I took of Warren there, and in the front of the screen is the corner of Bill Gates. Abraham Lincoln would have felt lonely on Wall Street. This was one of only a few humor in his annual letter to shareholders on page 5. Came out and said, Abraham Lincoln once posed the question, if you call a dog's tail a leg, how many legs does it have? And the answer to his own query is 4, because calling a tail a leg doesn't make it 1. For that reason, Abraham Lincoln would have felt lonely on Wall Street. And if you look at the Royal Banking Commission, I think there's a lot of bankers there that are trying to convince other people and truly believe that the tail is actually a leg. I think that's what he's referring to. 7, Buffett's prime goal in the deployment of capital is to buy ably managed businesses, as I said before, in whole or part that possess favorable and durable economic characteristics. We also have to make these purchases at sensible prices. He was referring to two things: looking at finding a elephant-sized acquisition so he could deploy the $100 billion that he's sitting in cash, but also to look at, well, what price will he be prepared to pay for Berkshire Hathaway shares. He came out numerous times through the annual letter to shareholders to say that he has been repurchasing a lot of Berkshire Hathaway stock. That suggests that while Warren Buffett can buy any company in the world, he thinks that Berkshire Hathaway is the best allocation of his capital. So Berkshire will be a significant repurchaser of its shares, is page 3. Transactions that will take place at prices above book value but below our estimate of intrinsic value. Now, the third quarter, they bought around $1 billion of Berkshire Hathaway stock. The last quarter, they bought just on $400 million worth of Berkshire stock. So not small investments at all. And as he said, Berkshire will be a significant repurchase of its shares for futures, for the future. But only when pricing below intrinsic value. Now, he's just purchased below intrinsic value in December. We're not too sure what he's been buying in the first quarter of the year until those announcements would be made in a few months. But I would anticipate over the last quarter he's been buying stock as well. And that's where I look at the investment recommendations. NAB's a no-brainer when you've got a put option because the risk is very, very low. Berkshire Hathaway, I don't need to analyze the company. Call it insider information. It's not insider information because it's market information, but there's a 14-page report, and Warren has to report what the company is actually buying on a regular basis. So if you want to know and put where your money where Buffett is, Berkshire Hathaway is one area that he's purchased a lot of stock at recently. That's a photo I took. End up having dinner at the table next door to Bill Gates and Warren. That's Warren with his back to us and Bill Gates on the other side. What do they have in there? It's not called a spider. What is it called when they have the ice cream in Coca-Cola? Cherry Coca-Cola? What's it called? It's like a spider. Root beer, not a root beer. Something like a spider. If you know what the American version is of what they call that thing, let me know. Just put it in the question section. So I'm not sure. I am sure it just skips me right now. Floater, Coke floater. Number 8, blindly buying an overpriced stock is value disruptive, a fact lost on many promotional or ever optimistic CEOs. He's once said before that if you get insider information from the President of the United States, you probably lose half your money. If you get insider information from a ever optimistic CEO, then you're probably going to lose all of it. So we've got to be mindful that, you know what, CEOs probably isn't the best person to get information on, unless they're buying stock themselves, as we've seen with Buffett buying stock. So yeah, it's an interesting quote that when you move to the smaller end of this, the sector, and listed companies, many people fall victim of. For 54 years, our managerial decisions at Berkshire have been made from the viewpoint of the shareholders who are staying, not those who are leaving. Consequently, Charlie and I never focused on current quarter results. So he's buying companies that are going to produce earnings in the future. Sometimes he's buying companies, what he calls cigarette butt investing, where he can pick it up and buy a company really, really cheap, if not for free. Like a cigarette, you can pick it up off the ground. You might be able to get a little puff out of it. So you've been able to get more value than what it's cost you. Cigarette butt investing. Warren Buffett invented that. I'm not suggesting you go to cigarette butt investing because it can be quite risky, especially if you're paying something. If you're picking up for nothing, then it's a pretty good deal. But his focus here in this point is that you buy companies for the long term. You don't worry about the share price next week or next month or next quarter. Berkshire has repurchased around $1.4 billion US worth of stock and expects to be repurchasing a lot more shares in the future. The last point and the most important point of the presentation. So Warren Buffett way, company must have the following characteristics. Quality management, there is none better than Berkshire Hathaway. Warren and Charlie, they have 54-year track record of producing 20.5% performance on the share market, the share price. So they've got a long-term track record of providing superior returns to investors. This is a simple and easy business model. It is just an investment vehicle. Berkshire Hathaway has an insurance arm, or what they call 5 key parts of their business, and then it owns a few listed companies outside of that. But in its own right, it doesn't do anything other than the deployment of capital. the allocation of capital. There's around 20 staff in Berkshire Hathaway, and it's the seventh largest company in the world. It is the largest non-tech related company in the world, right? Yet they employ around 20, 30 people. Most of them are there to fend off phone calls from people like me. But the other part and the most critical component of his investment principles is to buy when asset prices are cheap, when there's blood on the streets. There's a Berkshire Hathaway share price, 20.5% over the last 50 years. If we concentrate on the last 12 months, it's pretty flat. So when the US share market has fallen, when global markets has fallen, when the Australian share market has fallen, the actual the Berkshire Hathaway share price has stayed quite stable, which suggests he just doesn't outperform and make a good return when the market goes up, but it's quite stable when the market falls, which I suppose coincides with his building a fortress to mitigate the downside. There's some of the purchases that Berkshire Hathaway has bought while there's been blood on the streets. He's been pretty active despite, at the same time, not finding an elephant-sized acquisition more recently to deploy some of his 130 billion sitting in cash. If you look at those things, Buffett has bought $1 billion worth of his stock the third quarter, and then again $400 million in the last quarter. Warren Buffett sent strong signal to the market with Berkshire Hathaway $1 billion buyback. The last time Berkshire Hathaway bought shares was interesting. It was after a 12-month period where the market went sideways. So that was back in 2012 when the Berkshire Hathaway B-class shares was trading at 84. 12 months later, it was trading up, 3 years later, it was up 57%, which was pretty good, right? It suggests that when Warren Buffett buys, especially when he buys his own stock, it's historically been a pretty good investment. So look, we're a new investment linked to Berkshire Hathaway to make it easier. Most of you have invested in Berkshire Hathaway or heard us talk about Berkshire Hathaway before. So it's exposure to Buffett investment company. We get exposure to currency movements on any gains. There's 3 risk management techniques built into the investment. You essentially borrow 100%. The borrowing rate is 5.95% fixed for the 3 years. You pay that up front with a 2% currency hedging fee. You can borrow the full amount with your self-managed super fund, or you can invest outside of super. We know exactly what our downside risk is. It is the interest and the hedging fee paid up front. Every quarter there's a liquidity event, but that should only be treated as an opportunity to take profits. There's potential for yearly income distributions by way of coupons, but that's not guaranteed because Berkshire Hathaway doesn't pay a dividend, so we pay it out of gains. It's a 3-year term. Look, so for 100 grand, your outlay is 23,850. So 23,850 will give you 100 grand exposure to Berkshire Hathaway. 23,850 is the maximum amount you can lose. If the share price stays the same or falls every year, or for the 3-year period, you lose 23,850. So you've got to be comfortable with losing that on the downside. Even if the share price stays the same, of course, it's interest and hedging fees, that is at risk. If we look at I'll get through that. The risk, well, look, if it goes back up 57% over the 3 years, 23,000 is worth 51 grand in total. So the upside potential is magnified because it's a leveraged investment, right? Where I was talking about National Australia Bank before, it's very low risk because we buy stock, we buy a put option, there's no lending. It's mitigating the downside to be quite low. This investment is a lot higher risk because our outlay is the prepayment of interest and the hedging fee. Because that is carrying costs, you can lose all of it even if the share price stays the same. So you have to be prepared for that risk when looking at it. And you can mitigate the amount of risk you take on by having a smaller investment or none. The upside is magnified. It's a lot higher for this investment because of the leveraged nature of the investment than NAB, but look, so too is the risk. Key risk, there's no guarantee the investment will go up. There's no guarantee that Berkshire will go up despite its historical performance. If it doesn't go up, then that 23,850 is at risk. Your entire 23,850 is at risk. The counterparty credit risk is an investment grade bank. So look, that's just a key summary of going through the risks. I'm just conscious of time. So look, I think rather than going through, well, a lot of people go, what happens when he dies? Because Charlie's 94 and Warren's 89. A lot of people thought that Apple's share price was going to fall when Steve Jobs, who was such a leader and powerful influence of Apple, which is the only person that I can make a similarity to when we look at the power and significance Buffett has when making decisions for Berkshire. So Apple's share price, a lot of people didn't buy when they knew that Steve Jobs had cancer, and they thought when he passed away, the share price will eventually fall. But 12 months later, when people realized, well, hang on a minute, Apple's a big company, and whether or not Steve's there or not in the new world, it's still going to go on to make innovation and profits. I think with Berkshire, it's even a bit better because if Warren passes away, or Charlie, Coca-Cola is still going to sell a lot of Coke. Their livelihood doesn't impact the sales of Coca-Cola or American Express or Sea Candies or Goldman Sachs or Bank of America, Wells Fargo, Geico, some of the largest companies that Berkshire Hathaway holds. All of them, they're going to continue with or without Buffett. So I anticipate the share price to be re-rated significantly on the upside when these guys retire or eventually pass on. Steve Jobs was up 72%. So my picks, sometimes the market can remain irrational for longer than you can remain solvent. Remember that. An economist will tell you today why what they predicted yesterday didn't happen. That gives you a lot of confidence in my decision of where to deploy some capital. My picks, to be cautiously optimistic, to build that fortress, to consider risk management. Australian banking sector, NAB, but only with put options. Secondly, follow Buffett, Berkshire Hathaway. The final one, as I said, risk management should be number one and should be number three on the list. The first and the last priority when investing. So look, if you do want a copy of the PDS, the investment closes in a few weeks. Send me an email or your advisor at the SMSF Club, and they can go through the PDS and email it to an application form. I've got a few questions here. How do the losses from currency differences between US and AED work? So we're buying Berkshire Hathaway shares, or the underlying exposure is through Berkshire. That's listed on the United States. So if the currency falls in value, then well, first and foremost, it's only on any profits. So right now, the share price has gone up around about 1.2% from where we were 12 months ago. The currency, however, has improved. The Australian dollar has fallen against the US dollar, but that enhances our return. So if the Australian currency moved 10% and our Berkshire Hathaway share price went up by 10, that means it would be a payout of 11. It's only 10% of the 10%. So if it went up 20 and the currency moved 10%, our payout will be 22. Conversely, if the Australian dollar increased in value, which would mean that our coupon or our final value will be less, if the Australian dollar increases by 10% and the payout was 10, would get 9. If the payout was 20, it would be 18. It'd be reduced by the 2%. So that's the sort of how it impacts. It only impacts on the gains. It doesn't really have a big material impact of the overall return. However, it does influence the final value to you as an investor. It's a good question. Floater, a few people there putting spider, not too many questions about what's going on in the market. Sectors to avoid, just the normal sectors to avoid, the ones that are more speculative in nature. Investing your super money should be for the long term. And I'm surprised every year about a handful of clients that I see that have done the wrong thing, fallen for a Nigerian share scheme. Yep, you got it right. We have a few investors over the last 12 months that have lost their money overseas to a scam. So stick with Australia. If someone calls you internationally and asks them for your money, don't do it. Remember, superannuation is for your retirement. It's not to be spent early. For that reason, most of us have got a long period that it's going to need to last us for. Whether you're approaching retirement now or in retirement, I'm pretty sure you're not 90 or 95 years of age. Your super's got to last you that long. So make sensible long-term investments over asset classes that have provided a long-term track record of providing a superior return to investors. Choose sectors and investments that have a moat around them that improves the chances of you making a profit. And then finally, buy when there's blood on the streets. Property now, look, there's a lot of blood in the streets. It might get a little bit cheaper, might not. It depends on the area that you're looking at, as all areas of different economic drivers. But like from a macro perspective, if you've got cash right now, I think you can negotiate pretty good terms. So it's it's a good time to be investing. There's blood on the street, so just do it to ensure that you've got risk management. So look, thanks very much for tuning in. Thanks very much for participating in a few of the games on the what stock is this one. Hopefully you've learnt a few things about investing and the volatility of share prices despite stable earnings and stable income like dividend income like National Australia Bank. So thanks for tuning in, and good night. Happy investing, team.